L. Knowledge of general business terminology, practices, processes, e.g., organization structures, compensation structures, stock options, regulatory compliance, etc. FP&A professionals operate across multiple organizational functions and support strategic decision-making throughout the enterprise. Finance professionals must understand how businesses are structured, how departments interact, and how operational processes influence financial performance. General business knowledge improves communication with management, enhances analytical effectiveness, and supports cross-functional collaboration. Common areas include organizational structures, compensation systems, governance practices, stock-based incentives, regulatory compliance, and operational workflows. FP&A professionals translate financial information into actionable business insights, making broad understanding of corporate terminology and business practices essential for supporting planning, forecasting, reporting, and strategic analysis activities. Organizational structures define how authority, communication, and responsibilities are distributed within a company. Common structures include functional, divisional, matrix, flat, and hybrid organizations. Functional structures group employees according to specialized activities such as finance, marketing, operations, or human resources, improving expertise and efficiency. Divisional structures organize operations by products, geographic regions, or customer segments to increase responsiveness and accountability. Matrix structures combine multiple reporting relationships, allowing employees to support both functional and project-based objectives simultaneously. FP&A professionals must understand organizational structures because reporting relationships, budgeting responsibilities, resource allocation, and decision-making authority vary across organizations. Knowledge of corporate hierarchies and business functions improves collaboration and strengthens financial planning effectiveness across departments and business units. Compensation structures are important business practices because they influence employee motivation, organizational performance, talent retention, and overall labor costs. Compensation systems may include base salaries, bonuses, commissions, profit-sharing arrangements, stock options, restricted stock units, and non-financial benefits. Organizations design compensation structures to align employee behavior with corporate objectives and strategic priorities. FP&A professionals analyze compensation costs carefully because personnel expenses often represent a significant portion of organizational operating costs. Incentive compensation programs also influence forecasting assumptions, profitability analysis, and workforce planning activities. Finance teams frequently evaluate compensation trends, productivity metrics, and performance indicators to assess the effectiveness of compensation strategies. Understanding compensation terminology improves communication with human resources, executive management, and operational leaders during budgeting and strategic planning processes. Stock options and equity-based compensation programs are commonly used to attract, motivate, and retain employees, particularly in public companies and growth-oriented organizations. Stock options give employees the right to purchase company shares at a predetermined price, allowing them to benefit from future increases in share value. Other forms of equity compensation include restricted stock units, employee stock purchase plans, and performance shares. FP&A professionals must understand these programs because equity compensation affects earnings per share calculations, dilution analysis, tax planning, and financial reporting. Equity-based compensation also influences cash flow planning and long-term incentive strategies. Organizations often use stock incentives to align employee interests with shareholder value creation and support long-term organizational performance objectives. Regulatory compliance refers to the processes and controls organizations use to satisfy legal, accounting, tax, labor, environmental, and industry-specific requirements. Compliance frameworks help organizations reduce legal risks, maintain ethical standards, and protect stakeholder interests. Public companies must comply with regulations issued by authorities such as the Securities and Exchange Commission, tax authorities, labor agencies, and accounting standard-setting bodies. FP&A professionals support compliance efforts by ensuring accurate reporting, maintaining audit documentation, monitoring financial controls, and evaluating regulatory impacts on forecasts and business operations. Compliance failures may result in penalties, reputational damage, litigation, or operational disruptions. Understanding regulatory terminology and governance processes therefore strengthens financial analysis, internal control systems, and enterprise risk management capabilities within organizations. Business processes are structured activities organizations use to achieve operational objectives and deliver value to customers. Common business processes include procurement, production, sales, customer service, payroll, financial reporting, and supply chain management. FP&A professionals must understand operational workflows because business activities directly affect revenue generation, cost structures, working capital, and overall profitability. Process knowledge enables finance teams to identify inefficiencies, improve forecasting assumptions, and support operational decision-making. Modern organizations increasingly use enterprise resource planning systems, workflow automation, and data analytics tools to improve process efficiency and reporting accuracy. Cross-functional collaboration between finance and operations strengthens strategic planning and performance management by connecting operational drivers with financial outcomes and organizational goals. Communication and business partnering are essential components of modern FP&A because finance professionals increasingly serve as advisors to management and operational leaders. Effective communication requires understanding common business terminology, industry language, and organizational objectives.